Just now, silver just touched $87, and in doing so, it cracked two historic levels at the exact same time. Not a small resistance, not a random technical line. Two levels this market has been grinding toward ever since the violent collapse from $121. Two levels every institutional trading desk had marked on the same chart, and both of them broke in the same session. Right now, silver is trading at $86.91 as of March 9th, 2026, and directly underneath that number, invisible to most retail investors watching the spot chart, sits the most dangerous statistic in the entire silver market: open interest. The March 2026 COMEX contract still holds between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 to 455 million ounces of silver. And while the March delivery cycle continues to pressure the system, something even more dangerous is happening quietly in the background. The May contract is now accumulating what analysts are calling the most concentrated open interest buildup in COMEX history, 384 million ounces sitting in May, and a registered vault that cannot cover it. Two historic levels broken at 87, 384 million ounces building in May, and the delivery clock that started March the 2nd is still ticking. Over the next few minutes, we're going to walk through exactly what broke, why it matters, and what 384 million ounces waiting in May means for the price of silver once the March delivery stress test finishes its work. This is John O.G., one name, one voice. The fingerprint they cannot duplicate. This channel has never sold you anything and never will. If you're new here, subscribe right now, because the two technical levels silver just cleared at $87 are the exact signals institutional desks use to determine whether a structural bull market has survived a crash. The 40% collapse, the margin hikes, the hawkish policy narrative, the dollar safe haven rally, and now both of those levels are gone. If you had $87 marked on your chart before today, drop OG in the comments. One word. Let's go. If silver continues gaining momentum, liquidity begins pulling toward the high trade node above current price, where analysts are watching the bearish fair value gap between $87.71 and $88.17. And sitting directly beneath that zone is one of the most important levels in technical analysis: the 0.5 Fibonacci retracement, the exact 50% retracement of the crash from 121.63 down to $79 lands at $87.17. That is level 1. A specific threshold where quantitative trading systems, institutional momentum funds, and algorithmic trading desks begin switching from defensive positioning to structural long exposure. And silver at $87 just crossed it, but the second level is even bigger. Silver already shattered the 13-year resistance zone between $50 and $54, a barrier that kept the market for over a decade. Once that ceiling broke, analysts identified the next range with almost no meaningful technical resistance, the $72 to $88 band. Silver has now reached the very top of that range. When a market climbs through a zone with no seller clusters, something unusual happens. Price moves through what technicians call a vacuum. Once the ceiling breaks, the next move is no longer measured in small increments. It's measured by distance to the next historical resistance zone. When silver first crossed $80 earlier this year, analysts called it a new era of price discovery. That phrase matters, because price discovery means the market is entering territory where previous historical resistance no longer exists. Silver at $87, breaking two historic levels simultaneously, confirms something far bigger than a short-term rally. It confirms that the structural bull thesis, built on 6 consecutive years of global supply deficits, shrinking vault inventories, and rising industrial demand, survived the crash. Now we need to talk about the number that makes this breakout far more dangerous for the system than any technical signal so far this year. 384 million ounces in May. The May contract exists for a reason. It traditionally becomes the secondary delivery month for participants who could not secure March delivery. If March experiences stress, the demand does not disappear, it simply rolls forward. And that is exactly what is happening right now. Every entity that stood for delivery in March, but accepted a cash settlement instead of bars, immediately rolled its demand into May. The solar manufacturer that needs silver for production lines, the EV component supplier, the semiconductor fabrication plants, the defense contractors, the AI infrastructure manufacturers. Their factories do not stop because the exchange needed flexibility. They simply re-enter the next contract month, May. The numbers are staggering. March open interest originally represented roughly 500 to 528 million ounces of theoretical silver. Even if only 10 to 25% of those contracts demand delivery, the exchange must provide between 70 and 90 million ounces. The official registered inventory currently sits between 103 and 113 million ounces. That math barely works. But here's the problem. Every ounce delivered in March reduces the registered vault before May even begins, and May is already carrying 384 million ounces of open interest. Even if just 20% of that demands delivery, that equals 76.8 million ounces. And that demand arrives after March has already drained the vault. Meanwhile, the physical market is tightening globally. COMEX warehouse inventories have been draining for months. Shanghai inventories are near their lowest levels in nearly a decade. And physical silver in Asia is trading 12 to 13% above Western paper prices. When physical buyers pay double-digit premiums for metal, it signals one thing: immediate supply scarcity, which means the May open interest buildup is not a future issue. It is a present accumulation happening right now while silver simultaneously breaks historic technical resistance. Now let's talk about what those two broken levels imply for the price path ahead. One algorithmic model published before today's breakout projects, silver reaching $89.92 within 7 days. That would place the market right back at the $90 psychological barrier. And $90 matters for a reason. Institutional forecasts for 2026 already sit far above today's price. Some banks project average silver prices between $85 and $100 for the entire year. Silver at $87 today means the market is already trading inside that projected range in the first week of March, which forces one of two outcomes. Either prices spend the rest of the year well above $87, or the forecasts themselves were too conservative. Other analysts place 2026 highs near $118. And the technical breakout we just saw is historically the type of signal that appears at the beginning of a move, not the end. Now the honest counterargument. Some technical analysts still view the entire move as a corrective rebound inside a larger bearish structure. Silver's all-time high near $121 remains the dominant resistance level. From that perspective, the rally from $79 to $87 is still technically a lower high. Breaking the 50% Fibonacci retracement confirms the bounce. But the true structural confirmation comes at $94.80. A weekly close above $94.80 would officially invalidate the bearish structure. Until that happens, the bull case remains provisional. John O.G.